Michele Schneider over Christine Lagarde any day of the week, and she happens to be with us today. So Dale, I'm going to pass it over to you. Have a great Easter weekend, everybody. Make sure you guys stick around for Michele Schneider, Stelios, Steve, K-Man, and then also Grega. Thanks for joining us today on the F.A.C.E webinar. You guys have a great long weekend. Dale, it's all yours.
Thank you all. Bye-bye.
Thanks, Blake. Thanks, team. Michele, welcome back. Great to see you.
Nice to see you guys.
Lots happened since you and I last talked. A war, some NASDAQ stocks really taken to the woodshed. Everyone, holding up Cathie Wood as the poster child of this correction. I'm curious with what's been going on here. I've never seen people more bullish about commodities since the 70s, Michele, and you were very bullish early on the last few years before it was fashionable to be an inflationista. So right. I'm thinking,
I'm either the broken clock who finally got right, or such a genius that I was ahead of the curve.
No, because you're a great technician, and you and Keith work hard and study the markets, and you have for decades, and you learn. Experience can't be really, you have to live and go through different market cycles. And I think you and I have seen a couple. Does it feel like the market's a little bit on one side of the ship right here? I'd say the most hated position would be debt, any kind of bond down here. And everyone loves oil and gold.
Well, definitely there's reasons. I mean, it's one thing if it was just a crowded space of gold and oil and food, which is really the thing that I've been talking about for the last couple of years was going to drive this inflation. And even though oil has been the major focus in the media, as it should be because of the Russia-Ukraine situation, historically, if you go back into the 70s, oil was the one that went up first during the oil embargo. Right. And it took about a year later for everything to start catching up. And now we have the oil up and everything up at the same time. So the relationships are going to be a little bit different. I still think that oil, I mean, I've heard people who I really admire and respect say they think oil's going to $250 to $300 a barrel. I don't know if that's going to happen. What I do know is that we're not going to see much downside here. I don't see any fundamental reason why there's going to be a big outpouring of oil on the market to be able to satisfy the lack of supply we've been now not able to get out of Russia.
Could demand destruction out of China, Michele, with them locking down the whole country? Let's face it, they're the consumer of everything.
Exactly, but they're going to come back. That's the thing is they're going to come back. They're not going to stay locked down for forever, and they're locked down, and these people don't have anything to eat. I mean, from what I've heard. So, and the shelves are empty. And yes, that's another big area. But I'm sure that, we can see that she has been buying oil from Russia and will continue to buy oil from Russia, whether they're right now have bigger demand because people are locked up. It's only 26 million people. And it says only 26 million. In this country, that's a percentage. In China, it's nothing. You have 1.3 billion people. So it's still relatively small comparative to their population. I think but whatever we have in terms of a setback as far as demand in China is only going to then catapult more forward when Shanghai opens up again. So, and there's a couple of other little towns in there. But, let's put the oil on the side. Oil is not going down anytime soon. How far it goes up remains to be seen. But I'm still more focused on the impact on food, even more than anything else, industrial metals or miners or anything like that.
Because they're not economically sensitive, and there's nothing, higher rates that may cause demand destruction is not going to want to put people on diets.
Exactly, because the one thing that we absolutely must do is eat. And the problem with the food seems I don't see any relief in sight. I mean, we have a USDA report, I think, coming out next week. I'm not 100% sure on that. But what we do know is Ukraine, big exporter of food, even if the war ended like next week, and of course we all hope that happens, it's still going to take a long time for them to be able to come back to capacity. Here in the United States, if we have any kind of drought, which already is prediction for drought, or floods, which we just had, believe it or not, I just read in South Africa, they had these tremendous floods that destroyed a whole bunch of stuff and really almost stopped any kind of port in terms of goods going in and out. There just seems to be, like, at this point now, the threat to the food supply versus the demand is one thing. Now let's take it a step further. What happens when people don't get enough food? We're already seeing it. There's been protests in Peru. Right. There's been talk of social unrest in China. I don't get too worried about that because China squashes anything that gets out of control pretty quickly. But there has been in other areas in Africa as well. There's been problems.
Middle East had a problem last time there was a wheat shortage, and this.
Well, the Arab Spring emerged from food issues. So, and in this country, we're still relatively tame. And what's so interesting about this country is, after so many years of complacency, that I think has been somewhat intentional from many places, but let's say corporate at this point, to keep people fat and happy and sedated and into their toys and watching TV and, thinking that they have to look a certain way and feel a certain way and be a certain way. People don't even really seem to be, they complaining. I hear people complaining about the food prices all the time, myself included. But nobody's really at the point of social unrest here. So if we get to that point, that'll be interesting. So, these are the kinds of things that I think about, which is why we've been telling everybody to buy the softs and the food commodities. DBA, we've been in forever. We added to that position. And regardless of what happens.
Let's see your pantry. Let's see your pantry, Michele. I want to see, I know that you're prepared. And you've got lots of peanut butter.
I'm a vegan, so, as long as I can grow something, I can eat it.
Do you have a victory garden like the 30s? Everything's coming back.
No, actually, I'm very ill prepared. I think most people are, I have a couple of friends who are like, survivalists, but they're nut jobs, but maybe they won't be so nutty.
You never saw yourself walking around in a Mad Max environment, did you?
No, I'm under the ilk that if we got to that point, I've lived a long life. You guys handle it. I'm out of here.
I hear you, Michele. And you know what else exacerbates the whole grain situation is the cost of fertilizer. So, I mean, the input cost for farmers makes it almost, and in many cases, not worth planting, even with these kind of prices. Right. So, it's all coming together in a perfect storm. I do think the Fed could have impact on industrial commodities like copper, oil, lumber. I think that's what they're going after anyway, is that they want to slow down the speculation in financial markets, stocks and real estate. Is that your read on them?
Well, I don't know if they really know what they want to do. I think right now that's been another really big issue is, so, we've talked about the commodities, and that's why, like I said, no matter what I hear about it peaking and all this other stuff, I take that with a grain of salt because I don't think they're thinking about food, especially since, PCE doesn't even count food as part of the equation. I think they're thinking about things like used cars and stuff that you're right, that once things get too expensive, and now you mentioned housing at some point, but even the housing is in a unique situation right now because there's a shortage of housing still.
They can't find windows to finish off the houses, I'm hearing.
Which has now also even created more of a housing shortage. So people who want to buy homes are paying up because there isn't much homes out there, or aren't much homes out there. And on top of that, even with the mortgage rates going up, they're going, okay, well, 5%, but it could be 8% in a year. So I better buy it now. And so right now, we still haven't had a switch on that. So the housing market is interesting because, getting back to the Fed, what's really happening here is that these calls for recession, this recession is not going to be a typical recession because of the housing market is not going to collapse at this point. I mean, could it? Yeah, sure. But I don't think the Fed is going to goose up the rates nearly as much as they would have to get that to that point. Two is we have a labor market where we still have so many people who haven't even gone back to work, with about 11 million jobs still needing to be filled.
What are they doing, Michele?
They're
What
trading.
are they doing?
They're trading.
You really still believe that? I mean, Robinhood is taking the hit. You think
Forget
that they
about Robinhood. They're trading. I just came from a conference in Real Vision conference. I was one of the speakers, which was such a great honor to be the woman representative in the trading world. And how unusual for me, right? And so while I was there, I got to see a lot of people, talk to a lot of people who attended the conference. And I can't tell you how many people are quitting major careers to become full-time traders. Partly because they think they can trade cryptocurrency, and partly because they think that the equity market they're going to make more money. And now with it being commission-free,
right,
they don't have to worry about that. And so that's why at least these people came to a conference to try to figure out how to do it. But there's a whole lot of people who just think that they can do it. And so to me, the equity market is much more vulnerable than the commodities market, not just for all the reasons we just stated. Even the ratio between commodities and equities, even though it was at a 100-year low just 2 years ago, has come in, but it's still nowhere near where it could be. And now you have all these speculators who have come into the market, who will continue to come in the market, buy these dips, and then realize that, we're in a trading range. We're not going to new highs. That's not happening anytime soon. We're going into stagflation. But anyway, let's get back to the Fed. So you have the labor, you have the housing, and then you also have this disconnect, as we started to say, about the US consumer that is just so tired of being home and not doing anything after COVID, that they're out buying stuff. They're out eating out in restaurants. They're complaining about the prices, but they're adding to their debt right now.
Yeah, they're using credit cards to buy groceries.
Exactly. So, which is something most people always did, except for during COVID. So now we're not going to really necessarily go into recession, but we're certainly not going to have any economic growth. So here we are. You and I, Dale, talked about stagflation for the last couple of years. It was inevitable, and here we are. So what do you do right now? What is the Fed going to do? The Fed certainly knows that from stagflation, you can go into recession, or you can go into hyperinflation, and we have a midterm
election. Both.
Yeah. Oh, yeah. And so in some ways, I think they'll do some of it down into recessionary areas. And in some ways, they have no control. We'll see the hyperinflation. And so this is an environment where you have to be a super creative trader, because this is going to be unlike anything that anybody has ever seen in terms of fitting into a box: recession box, inflation box, stagflation box, goosing up rates box. All of these boxes now are so
unprecedented.
Yeah, exactly.
Has your family broken up, or are they still together? You know who I'm talking about, those guys. you know the family that you would always present.
You're talking about my modern family?
Yeah, your modern family. What, are they fighting with each other right now?
Yes. Well, no. Yes and no. Not really. They were for a while, where you had semiconductors still doing really well. Yeah. You had transportation holding up. But yet retail and the Russell 2000 and then even the regional banks were doing well for a while, but now they're all lower. The only thing that's actually reversing is biotechnology. And biotechnology makes sense, because in this environment where people are coming back from COVID, they're finally going to take care of things that they didn't take care of for 2 years, just normal health stuff. And so we're actually long, in terms of equities, we hardly have any equities on, but we do have biotechnology as one of the areas we're looking at.
It's
and
pretty
are in
defensive.
already.
It's pretty defensive as well, isn't biotech? Would you
It
call
is.
it
Well,
that?
it's a cyclical and it's a non-cyclical. And that's the advantage of my biotechnology member of the family. But the rest of them, they're all in consolidation mode, hanging on to recent lows. And if they break these lows, I think we'll see another leg down.
Yeah.
Do I think we'll see a vicious sell-off? No. And in terms of the interest rates right now, they've got so oversold. As if you just look at the TLTs, I wouldn't even be surprised to see a bounce,
Yeah.
especially if the market goes lower.
DSI got to 5, Michelle, this week. It's a
Yeah.
pretty low reading.
That's a
5.
pretty low read. Yeah. So I wouldn't be shorting the bonds here. Let's put it that way.
What do you think about the dollar? Let's make history that the dollar is peaking up here on our interview, or maybe it did it in anticipation of our interview yesterday. Are you looking for the potential of a turn in the dollar, especially after we weaponize the SWIFT system and we're overdue for some type of dollar decline? And would the Fed welcome it?
Well, yes, it would make it easier for the Fed, for sure. And remember, one of the things that Donald Trump wanted was a weaker dollar, because a weaker dollar is good for a lot of things. But right now, here's the thing about the dollar. I bought F.A.C.E. because as soon as the dollar has gone par with F.A.C.E., which means, for people who don't know what that means that the dollar and the F.A.C.E. are at the same rate, right? So if you go to Europe right now, you're not getting any great advantage with your dollar, but at least you're not getting a big disadvantage like you had for so long. So what's happening right now is at par. If you look back since 2017, every time F.A.C.E. got to par with the dollar, F.A.C.E. had a big rally. But it had a really big V bottom type rally. It wasn't like anything that you had to guess about. It went down straight and then went up straight. So
Like
right now, here we are. We're at par, basically, right now. I had bought the F.A.C.E. a little bit higher, and I got out because I wasn't sure. The dollar's been sort of this safety net play, which has made it portended to a point that I thought was a little bit silly, considering our inflation numbers.
Yeah.
So there's a lot of manipulation there. But I would certainly be keeping my eyes on it, if not today, because we have a long weekend and anything could happen. If things blow up more in the Russia-Ukraine, we could see another spike in the dollar. But if things stay relatively calm and we come into next week and we're still around this par and the dollar starts to droop here more, or can't get back over 100 if you're looking at DXY, I would buy the euro, and I would just be, okay, I'm wrong if it breaks par. And if it continues to go up, I heard before talk about 108. I think that would be a reasonable target, potentially.
Okay. And commodity currency, since you are a inflationista food bull, would you be looking for buy spots in commodity currencies like Aussie or the Canadian or New Zealand commodity producers? And Brazil, their ETF is doing well. They're a big producer of grain, oil. Is that where people should stay if they leave the US? Look at those markets.
Well, I think that the emerging markets that have been commodity-based countries have done very well and probably will continue to do well. Brazil, of course, is the classic example, but even South Africa has done well. Even Australia has done well. Canada is not an emerging market, but the Canada ETF has done very well. What's interesting about EEM is that half of it is China, which, that's not doing so well. But and a lot of people are very negative in China. I think China has made policy-wise some mistakes, going after the tech the way they did. I think hurt the country a little bit. And so that's what slowed their economic growth. But do I think they're done? No, I think they're busy trying to figure out how to work with Russia and India to have their own little access. I think this deglobalization we're into right now has some advantages and disadvantages to be aware of. But I would be looking at commodity producing countries. And in terms of the US, let's just focus on the US for now. I'm more on the bearish side than on the bullish side, but I won't go short here. But what I did do is I bought volatility, probably not the first time, because I've bought it a couple of times, but more actively traded. I started a position here. We'll see. I mean, I always have a stop. I don't like being wrong. And if I am going to be wrong, I like to get out quickly. But I started this position in VIX because believe me, I know all the conversations about backwardation and blah, 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 and the relation to VIXX. I know all of that. And everybody told me the same thing 2 years ago when I started buying natural gas through UNG. Oh, you don't buy that. It's backwardation. Meanwhile, it was the best trade. And we just took another profit from it at over 24.30 yesterday.
Huge
so
move.
So I say, don't listen to all that stuff. If you just look at VIX right now, VXX, the 50 is crossing the 200. Which is the classic golden cross. The price is right on the moving averages. That is rare. That's like a picture perfect opportunity to say, if I get into volatility right now, I'll know right away if I'm wrong. But man, if I'm right, that would be an add type of trade, because that could be the volatility that people keep talking about, but you're not seeing it.
No, you've had a 20 to 30 range.
Exactly.
That's your range. So you think we could get a breakout over 30, that would measure 40, 50, something, a pretty nice move.
I think it's extremely possible. And once again, I feel like I'm one of the very few voices talking about this right now. I can only gather that from what I see on Twitter. And then the pushback that I get on Twitter when I say stuff like this, just like the pushback I got on natural gas 2 years ago, turned out to be 100% correct. And now I'm seeing this with volatility. If you look at implied volatility versus the discount, it's out of whack here.
You're like the Jeremy Grantham, female Jeremy Grantham, the super bear. I wanted to ask you something. Do you think, I know you think about these things, Michele, and the press is really underplaying it. There was a partial default by Russia. There was another default in Indonesia this week. And it seems like we're moving into, a place where there's going to be solvency issues. Some people are saying we're in a sovereign debt crisis. Do you think that if there's a Russian default, because we were in the business during the last one, that it's going to be a big deal for the market, even though we're generating it for them by freezing their assets, and we'll have to bail out the IMF and the World Bank, because that's basically us too, from the default. Have you thought about that at all?
Yeah, I certainly have seen the headlines come across about the defaults, and certainly about our own ballooning debt. And I know people are very concerned about it. I would say right now, it's already in the market. When I say it's in the market, that's not, it's priced in and it won't have another impact. What I'm saying is, I think the reason why we're floundering down here, but yet holding, is that same sort of disconnect of the reality versus the fact that people still have this idea. I hear this all the time, that if Russia goes into a default and the market goes down, the Fed's going to come back in, forget about raising rates, is going to come back in with more accommodative policy. And therefore, don't worry about it. That's, I think, the most dangerous thing, is kind of what you said, which is it's out there in the news. It's kind of being ignored. It definitely can have a domino effect. In some ways, it's already there in the market. We're seeing it, which is why we're more on the lows.
Yeah, JP Morgan took a counterparty risk hit just the other day. So there's tentacles on these Russian liabilities to counterparty risk all through the globe. It's a global banking system. So
absolutely, and that's why you're seeing this move to deglobalization. But that's the negative of the deglobalization here. In this conference, I listened to this guy. I can't remember his full name, so I'm not even going to say it. But he's one of the top geopolitical. And it's guys like, big deal. When I was listening to him, I was thinking, my God, I don't have any kind of knowledge like he has. And yet I came to the same conclusions because I can look at charts. Yeah. But nonetheless, one of the things that he said was that the US is actually in really good shape for a deglobalization because we have natural resources here, so we could take care of people. We are bordered by 2 oceans, so we're basically impenetrable. And we have the strongest military in the world, which means nobody's going to attack us, or if they do, it would be to very serious consequences. And that's been playing in my brain over and over and over again, because a lot of people would love to see us completely back into an isolationist country. But then on the other hand, you have to say, well, we've gotten so used to cheap goods from China in this country.
Yeah.
Are we really willing to pay up to be an isolationist country after years and years and years, decades of being spoiled? I mean, I was cracking up. I was on Cavuto this week, early in the week. I came back from this trip and I took thanks to Biden, one of those home COVID tests.
Oh.
And I was looking at the box and I'm like, it's made in China.
Yeah.
I was like, wow, that's really crazy.
Yeah. So you go ahead.
I know these are heady. These has nothing to do with what do we do in the market right now. But you're asking me if I think about these things. I think about these things constantly because we're into this huge game of chess right now. So I'm trying to be like 4 steps ahead so I can position myself well in the market, or at least, and my clients, at least be somewhat prepared if I'm wrong and everything just goes to the moon, like some people think.
Yeah.
Or I'm right and commodities stay very strong and equities fall apart and volatility goes crazy.
You know, an ex-girlfriend of mine told me that women are always 5 steps ahead of men. They had 5 moves ahead. Anyway, so do you think it would be more appropriate, instead of calling this a supply chain disruption, to call it a supply chain destruction, and that it's going to take years for us to begin to rebuild made in America, and it is going to be more expensive, but it's not going to happen overnight. Just in time is out of time, and this is going to be a long-term process?
That is such a great question because it totally just plays into everything we just talked about. So let's take that isolationist policy, because the good news is after we go through this period of complete disruption or destruction, as you say, in history, going way back, comes a period of innovation after that, which of course, innovation also always leads back to complacency because, hey, everything's going well, we can relax. But if we're going to go into an innovation and this scenario plays out, and we do actually get back to made in America, and we become less dependent on importing goods from foreign countries like Vietnam or China that make them cheaper, then we could actually have some kind of economic boom in this country. But like you said, it's years out, which is right now we are in. That's why I keep using the word stagflation. We're stagnating. We're not seeing any growth. We haven't seen growth in this country except for in the technology space, which is legitimate. But in terms of infrastructure, industrial, manufacturing, all of that, we've seen almost zero growth in that area. And I don't think we're going to start growing out of it right now because we've got so many other problems, inflation being the top one, and food especially. Then yeah, let's look out. Maybe in 5 years from now, we're in a situation where we can really see our way to America becomes completely independent and not interdependent. And that would be our next great big move up. That's a very roseate, optimistic viewpoint, but anything's possible.
Hey, you know what? I want to leave it with that thought that America is going to come through whatever we have to go through. And in 4 or 5 years, we're standing on our own 2 feet and proud of when we go into stores that everything's being made here, a majority, and we've come through the debt and the inflation, and happy days are here again. And we build this time on a rock instead of sand of debt. And Michele, I want to wish you, happy Passover. I know we have a wheat shortage, so we're going to people are going to have to get used to unleavened bread, I think. So really great being with you and hearing you. What a great time I just had.
Oh, thank you, Dale, and thank you, everybody. And yes, happy Easter, happy Passover. Yes. Have a great long weekend, and I'll see you again soon.
Okay, Michele Schneider, and you could find her on Twitter at Market Minute. And the name of your website again, Michele?
Marketgauge.com.
Yeah, go there, check it out. Minimum follow her. So that's a wrap, everyone. Have a great weekend. Remember, don't just count your pips, count your blessings. We'll see you next week. Recharge your battery and get your plan ready when the markets are closed. Good luck on the ECB. Thank you, Michele.
Thank you, Dale.
Bye-bye.
Bye.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.